Welcome to the daily update, where I'll go over the action in the market for Tuesday, March 4th, and we'll see how things look for Wednesday, March 5th. Had another down day. It looked like, okay, we were heading lower to begin with, and then we were able to rebound all the way back up to the unchanged level, briefly go positive, and then going into the close, the smart money came in and started to sell. So, we were off of the low for the session, and so far, the 200-day moving average for the S&P is holding, but we're getting really close to it right now. And the NASDAQ 100 200-day moving average is holding for the time being. We went down below it, but then we were able to close back above it. So some critical support is holding up for right now, but we're still looking more negative altogether. I just got done watching the president's speech, and the futures are up a little bit as I record this, but it's many, many hours before the market actually opens. We'll see what happens in Europe and how the futures can hold up in the overnight session. Okay, let's go back and talk about what happened and then look at some charts. We did have a gap lower open, and this is a little bit different than what we've seen lately. We've been seeing some higher opens and then setting the high for the day and then going down. Well, this time we gapped lower and we just kept falling after that. We quickly fell below 5,800. We fell below S1 at 57.78. And we got to within about 1% or so of the 200-day simple moving average for the S&P. And then we were able to establish a base as the market figured out, okay, are we going to break below this? Are we going to be able to go up from it? Well, then we saw some buying coming in. It was still relatively early in the day, about midway through the session. We got back above S1. We got to the unchanged level. We briefly went positive, but then we saw some late day selling, which took prices back down to close at S1. We were down 1.22% on above average volume. We are still negative in the short and intermediate term. We're getting kind of overextended to the downside in the short term. We're starting to see a list develop in the intermediate term, and we're still positive in the long term, though. Interest rates actually went back up a little bit. They've been coming down pretty quickly, and so to see them bounce back up was not necessarily a surprise there. Kind of the big geopolitical thing right now will be, okay, what's the fallout from the president's speech? Of course, it's very predictable. You had one side of the room just cheering and like they were sitting in a spring box or something, going up and down, clapping. The other side, I think everybody was glued to their chair and they didn't even move or clap, even for stuff that's kind of humane and nice. So they did have one person thrown out right at the beginning. That was kind of interesting to see. But the tariffs are now in gear. And what's this going to do to the economy? What's this going to do to the stock market? Those are some big variables right now. Okay, some comments. There are still economic growth concerns, and these tariff uncertainties are continuing. There's now it's not necessarily a trade war, but it could really develop into that. It's really getting more aggressive now. There are 25% tariffs on Canada and Mexico that went into effect, and China is now up to a 20% tariff. And the countries, they say, well, we're going to get you back, America. We're going to have retaliatory tariffs back on you. And then during the speech, President Trump said, well, whatever they put on us, we're going to put the same thing on them. What's it going to do? Go to 1,000%? Is this, like upping the ante or something here? There was late day selling after rebounding back up to the unchanged level. That's critical because that's the smart money coming in and doing some selling. Now, everything in the big sectors was down, but mega caps actually held up a little bit better. This is different than what we've been seeing lately. Growth held up a little bit better. It was down, but there was some likely profit taking in some of the more value areas or some of the rest of the S&P because we're seeing a little bit more weakness coming in right now. We're still getting a high reading with the VIX. We're above 20. And whenever we're above 20, that's when we see negative annualized returns. And we're at 23.51. And we're less than 1% away from the 200-day moving average for the S&P 500. We're still above the NASDAQ 100 200-day simple moving average. As I said, we dropped down below it, and I'll show you the chart later. And then we were able to come back up and close above there, above that level. So our list is getting kind of long. The VIX has still been going up pretty quickly, and I use a momentum oscillator, an RSI, and we're getting rather extreme that way. And then the usual indicators that we have, the Stochc RSI, Williams percent R, CCI 14 and 20, stochastics, the force index is back on there again. We're hitting that lower Keltner band, which is very similar to a Bollinger Band. The slope oscillator, our short-term oscillator, it's starting to get extreme negative, and we're still far away from the 20 period moving average. And then even the short-term RSI is now getting extreme again. We had worked off pretty much the same list that was here after last Thursday. It was almost gone after Friday. And then it started to build again after Monday, and it's continuing to build after Tuesday. And now in the intermediate term, we didn't have a list when I did yesterday's video. Now we do. We're into the -3 channel with our standard deviations chart. That means we're going down pretty fast. And the percent B, we're showing that we're below the lower Bollinger Band, and that usually doesn't happen very often, and it usually doesn't last very long. And we're getting far away now from the 50 period moving average. And I'll have charts to show you of all these things. No change to the scenario yet. I'm kind of waiting. I was hoping last week there might be some kind of a change, but really not. And then I'm waiting now to see about, well, first we have ISM services coming out in Wednesday's session, and then the big employment report on Friday. We'll see how things go there. The dollar was down. It's been getting hit hard lately. It's coming down pretty quickly, but interest rates, which had been coming down, they went back up. We're at 4.21%, where after Monday we were at 4.18%. Sentiment is still extreme. We're under that 25, excuse me, we're under the 25 level, coming in at 20 right now, where we had been at 24. And we're still inverted with the 10 to the 3 month yield curve. A couple more days. I'll keep watching that chart. I'll probably drop this out of the video because this can go on. It went on for what, 2.5 years or something with the 10 to the 3 month, and the 10 to the 2 year was, I think it was inverted even longer than that. So it's one of those things that I'll just keep an eye on, but I may not mention it in every daily video going forward. I'm just mentioning it now because it just happened last week. We're still negative with our trend. The red line's above the green line. We're strengthening there. The red line's going back up where we were a little bit encouraged after Monday, where the red line had actually come down a little bit, even with the down day. We're above the moving average. We're starting to work our way back up to 20. And again, with the down day, our bias is negative, and the last number of days taken together shows that we are negative. That's our momentum. All right, we didn't have any economic reports, so there's no charts to show you here. Let's look at some of these other charts. We see this every week, the overbought, oversold composite, and we're still above 50 here. Now, I use other indicators. This is more longer term. This is a composite of weekly technical measures where I'm looking at daily. And then we have some really short term indicators as well. But we're still above 50, even though we've been coming down. That's kind of the line between positive and negative. And then looking at the ISM manufacturing, which came out in Monday's session, and we're still seeing a bit of a disconnect here. The purple line, that's a year-over-year change for the S&P. This goes all the way back to 2011. And the yellow or gold line here is the ISM manufacturing index, where it had been coming up and it dropped off recently. And this is where some of the growth concerns are coming from for the economy. And then where are people positioned right now? They're still into stocks, but we're seeing money coming out of that. And then the positive Magnificent Seven earnings per share, it's stalled. And this is what I've also been talking about, is that we still see positive earnings going out into the future, but they're lowering those higher forecasts that had been there before. And that's why we're seeing it's still up 18%. My goodness. But we're flatlining right now. And we started to do this last fall, where we're actually down 1% for the S&P as a whole, and then the rest of the stocks in the S&P are down 5% with their earnings. And dividend payers. Don't talk about dividends too much in this particular program or in these videos, but this just shows it jumped to a 2.5 month high versus those stocks that don't pay dividends. Now, you have a couple of different choices with dividends. There's common stock, which this is most of the stock that we buy and we sell, and there's SPY, there's ETFs, and so forth. And a lot of those do pay dividends, which are profits that a company disperses to shareholders. And but especially back in the 90s, when I first got into this, you really didn't want these companies paying dividends. You wanted them putting money back into the company. You wanted capital gains. Well, there are also folks that have another choice of stock called preferred stock that tend to pay more dividends. Their stocks aren't quite as volatile, and people tend to get into that. Now, that's another alternative to maybe getting into bonds and then having the interest coming in. But this chart just shows that it's at a 2.5 month high. Well, we've been having trouble for 2.5 months with the stock market. And so when prices go down, the dividend yield tends to go up. And that's really what they're showing here. Okay, the aggregate U.S. equity futures and S&P 500 ratio to its 200-day moving average. We're coming down a little bit here. Folks are getting a little bit nervous, and then here's going back about, what, 15 years to different events that have happened along the way. And we're seeing a lot of money coming out of the, um, okay, I can't think of EM right now. Emerging markets, my goodness. I talk about this stuff every day, where they have been seeing some more positive things happening. And then for a while, world stocks were actually outperforming US stocks. But we're still seeing a lot of money going into money markets, government bonds, where we're seeing some money coming out of these balanced funds now. This is balanced between stocks and bonds. But this is a little bit surprising. Now, DM, that's developed markets. That would be like the US, Europe, and then there's second world countries like Russia and former communist countries. And then you have third world countries. Well, they don't like to be called that. So a lot of times we call them emerging markets, once I remember the name there. And then the risk appetite indicator coming down. We're just about at the tipping point right now. Folks are, and we see this in some other charts that I show, the risk on to risk off ratio. It's been coming down. This is measured a bit of a different way, but it's also coming down. And now this is another thing. Last week, I talked about in the video how the GDP now had been at 2.5% or so with a forecast, and then all of a sudden it went down to 1.5%. Well, they came out with another forecast, and they're down almost to 3% now. This has got some folks freaked out. Now, this is a forecasting tool, and a lot of times the real GDP number that comes out, I should say the authentic GDP number, because the real GDP number allows for inflation. It can be quite different than this, either to the upside or to the downside. So, but this is something that people watch. I go over this in every weekly video just to see how we're looking, and we're not looking really good right now. There are economic concerns about growth right now, and that we might end up slipping into a recession at some point. I have a lot of different charts that I follow. I try to keep up on this, and we can try to forecast and say, yes, we are, no, we aren't, but let's look at the data and actually see what that's telling us. Found one interesting chart here. The debate goes back and forth. And if you like Trump, you're probably at least somewhat accepting of tariffs. If you don't like Trump, like I said in other videos, if he came up with a cure for cancer, people would say, oh, I'm supporting cancer. That's just how divided we still are politically in the US. But up until they passed the income tax in 1913, I believe it was, right around in here, this is how, and even into the 30s, because this was during the Great Depression, but this was how the US government got its money, was from tariffs. And we didn't have an income tax before that. And then that's really become out of style with all these trading going on, and we have advancements with aircraft and ships and technology and so forth. Well, now they're really seeing this going back up. But it's even with the tariffs that are proposed and that are kicking into gear, it's not back to what it used to be. So if you study U.S. history, you could see some positive things here. You could probably also see some negative things here because there were a lot of things going on. The robber barons and where a small number of people controlled most of the wealth in America at that time, and you had to work for the company store and live in the company house, and then around the early turn of the century into the 1900s, that's when we saw the rise of unions, and then that carried us through the 20th century, Jimmy Hoffa and all that stuff. It just depends on where you come out, and it probably comes down to where is this impacting you personally, whether this is something that you agree with. Now, in the president's speech, and he said this before, it's probably going to be short-term pain, long-term gain. There's going to be some difficult times because there's a lot of things that he's trying to change that have been in place for decades and decades. And if you like that change, well, it could get a little rough for a while before it gets better. And that's why we're seeing these economic concerns and the stock market's been just kind of floundering to actually looking more negative now. And this may go on for a while. Okay, then you might want to stop and just look at this. I'm not going to go through this whole thing here. This is looking at the returns of all the 11 sectors that make up the S&P as of the time that this chart was actually created. And then what's their earnings per share growth? And then what's their multiple, the PE ratio? How has it been growing? And what you're looking for here is what's looking positive across the board. Right now, it would be financials. They're doing well. No, they got hit in Tuesday's session pretty hard, but they're also seeing an increase of earnings, and their PE ratio is growing, but not crazily. Or you look at some of the other things here. This is sorted based on where the returns were at that time. And then you have tech that's down and discretionary that's down. So if you're a sector watcher, and I watch that, but mainly because there are offensive areas, not meaning that you're offended, but growth areas that are sectors like discretionary, tech, communication. And then there are defensive areas like healthcare and financials are kind of, we want that to do well. 'Cause just that helps the overall economy. If the banks go down, that was the great financial crisis. Then we don't want to go through something like that. And staples is more defensive. Real estate is often considered more defensive, but interest rates keep going up, so that's been getting hit a bit there. And then some of these are just based on the economy. If the economy's doing well, energy in utilities, it's like, okay, we're with all this green stuff out there, are utilities a growth area now because we have electric vehicles, we have AI, we've got energy doing better now because you've got high-tech companies buying nuclear power plants and because they got to get their energy for their AI program somewhere. And so anyway, I look at this mainly to see what's the rotation going on, and that's what I go through in some of the weekend videos to how are these sectors interacting with each other. Okay. Now, let's go back. We did have a lower open and we immediately went down below S1. And right around here, we weren't quite at the 200-day moving average, but we're not very far from it either. And then it looked like, okay, but it may have started too early. We set up this base here, and then we started to see a nice little comeback. But we got right up to the unchanged level. Now, I post these pivot points every day, and on the YouTube community tab, I have a daily chart that's updated with that day's bar, and then I have the intraday pivot points that apply to that particular day, and I rely heavily on those. And I just post them out there. Feel free to go check them out. That's usually the first thing I post, even before I record the video. But we have these R levels, which are resistance, and a lot of times we'll go up to that level and then maybe come back down or at least stall. But if we break through one of these, that's seen as more positive. Then you have kind of the center line. This is the pivot point. And if we're above the pivot, that's considered positive. Below the pivot, that's considered negative. And all of these levels are calculated on an intraday basis on the previous day's action. Okay. Well, we came back up to S1 And this is a pre-calculated level. That's the cool thing about these. That's why these charts are posted on the YouTube community tab. We know these levels before, like they're already up there for Wednesday. And so you can go see them and use these levels before the market's even open and just to get an idea of what we're looking at. But what I'm getting at here is the unchanged level is like a built-in support or resistance level. If we're going up and then we pull back, we might hit the unchanged level and then bounce back up. Well, just the opposite of that happened on Tuesday. We were going up, we hit the unchanged level, try to go positive there, weren't doing that, and then that was about the extent of the rise. And then going in to the end of the day, this is when we saw selling that took us back down to S1. Now, I'm not a day trader, but I watch this stuff and I'm watching other indexes. I mainly look at daily charts with the other indexes where I like to keep an eye on what's happening on an intraday basis here with the S&P. And we're actually up. We're getting a little bit of a bounce as I record this. And I mentioned that earlier, but it's many hours before the market opens. But Europe was getting hit hard. They didn't have a good day, and that took the US futures down. That's this light blue area here. And then this is the kind of, I don't know what color that is, kind of a light brown. That's the cash session, and then this light pink area, that's the initial overnight session. Okay, we're still looking more negative now when we look at our intraday growth to value charts. The blue line, which is growth, is still below the red line, and they both got hit in Tuesday's session. And we saw a little bit of an improvement here with our S&P growth to value ratio. Now, we're still in a longer term downtrend, and we have been since about the middle of February. We'll be watching this to see if things are switching back. If this goes up, that might mean that we're going back to more of a pro growth type of atmosphere. But as we're coming down, this is when we're seeing things coming out of growth and going into value as the market is becoming more defensive. All right, end of day growth was down, but value was down even more. It was down less. The growth was down less for the mid caps and also less for the small caps, but everything got hit really hard. Okay, but when you look at the growth to value ratios for the small caps, we're back up to the 200-day moving average here. So a bit of an improvement there. We ticked up a little bit with the mid cap growth to value ratio, and we were just flat with the S&P growth to value ratio. But longer term, this is still in an uptrend. And we saw a little bit of a tick up here with our growth versus value ETF ratio. We had dropped below the rainbow. Now we're coming back up into the underside of the rainbow. And we saw this was actually one day when discretionary got hit. It's been hanging along here. Now, this is an equal weight discretionary ETF. So, in the regular sector, discretionary sector, Tesla and Amazon are so huge, they account for a large part of the sector. Well, this treats all of those stocks in the discretionary sector the same. And it actually had been holding up. Well, it got hit a little bit here. Staples got hit a little bit too. It's kind of battling around its 200-day moving average right now, but overall the ratio ended up going down. And we're dealing with the 200-day moving average when we look at large cap growth. We did drop down below it, but we were able to close above it. Is that going to matter? This is a big deal. The 200-day moving average is like the main moving average that folks use for their longer term investments. And if we can hold out above this, that would be positive. If we start breaking down below this and then closing below it, naturally that's going to be more negative. So we're still negative with the ADX. We're just coming up to 20 now. So we're just starting to have a confirmed trend here, but we're above the moving average and going up. The red line actually went up in Tuesday's session where it came down on Monday. So this is a confirmed intermediate term negative trend. We already were confirmed after Monday with the short term trend. We're above 20 going up and the red line's going up. So short and intermediate term, we have confirmed negative trends now. And we're well above average with volume here. And we're also seeing a real increase in with this indicator, the Ulcer Index, which uses closing values. It was developed a long time ago to mainly work with mutual funds that only have one price a day. And we're above 20 and going up with the VIX. And that's not a good thing. That's negative for the market. both on a closing basis, and we closed off of the high a bit here with the bar chart, but we're still well above 20. And the VIX of the VIX is also going up, even though it closed on pretty much a flat basis. That's kind of interesting. And we're going up pretty fast here with the speed of the VIX as measured by the RSI based on 9 periods. We're above 20 here. We're above the 70 level. Now we could still go higher than where we're at now, but a lot of times this can mark some kind of a short-term climactic event. And the momentum of the VIX is also up, which is negative. And then this is just kind of showing when you look at the 1 month contract, because you can actually trade the VIX, and there are people that do that. I just watch the VIX. A lot of people in the markets, anything that moves, they want to bet on it. It's like racehorses and dog races and all that other stuff. But this is the 1 month contract versus the 3 month contract. And what we're seeing here is kind of an extreme reading now that when we're really going down and when this comes up to red, this means the 1 month contract is actually higher than the 3 month contract. And sometimes that marks some kind of a bottom. And it's more intermediate term, but you can see it's not perfect. We had a signal here back in December that actually failed. Well, is this one going to matter now? This could end up being positive for the market. And we're still up in the red area with the skew index, which again is another variation of the VIX where it's calculated using different options, out of the money options. The market's still expecting a big move here, but we've been watching this for a couple of months now and it's been up in this red area. We're still keeping an eye on the spread between risky and not as risky bonds. This continues to go down. That means fear is increasing here. This is an inverted chart. Now, we've been down here before, right at the end of December, and this kind of marked a short-term bottom before the S&P went back up. Are we going to see something like that now? Now, if this continues to fall, you can see other times when this really kept falling, that was pretty negative for the market. So we just want to keep an eye on this. It's been pegged up here for so long. I don't talk about this chart in every video, but now that it's starting to really move, I've been bringing it up more. And we're seeing a little bit of a discrepancy here. We were up with this fear gauge. No, I guess not a discrepancy. We were up with this other fear gauge too. Where I didn't get any data is the equity put call ratio. I waited and waited until after the president's speech. This still hasn't updated. So these charts are not current. It's probably safe to say that we're still going up with the 5 day and the 10 day. And we coming back up a little bit here with the volatility risk premium. We're coming back above the band here. That means there's an increase in fear according to this measurement as well. And we've been holding up fairly well with the new highs, new lows. You can see that there's an awful lot of green here, but then there's an awful lot of red too. And so we're starting to roll over with the 5 day. We're pretty much flat with the 10 day, but this just shows kind of the internal structure. On one hand, you can say, okay, there's still a lot more green than red. That's positive, but to see the red getting more, that's more negative as well. And then we look at the advanced decline line, holding up fairly well as we've been going through some of this rotation. Even though it did decline a bit based on price and volume, we're still above these longer term moving averages. And we're starting to drop below zero down with our short term advanced decline ratio. And we're coming back down to the moving average. Disregard this boom indicator at the bottom. It has us already being extreme negative, which I don't know, you may never know. But the way this thing is supposed to be is that when we drop below the moving average, that's when we drop below the the blue line right here. And you can see that it's not where we're at. But we're still at the moving average. Now, we saw this last Thursday. And so we looked at, okay, maybe we'll get into some bearish positions here. But then we had a solid up day that pretty much wiped out Thursday's loss. Is something like that going to happen now? So it depends on your interpretation. Because we're still kind of at the moving average right now, you could take that as positive. But because we're declining, you could take that as negative. Now, after Monday, this was looking a little more encouraging. Checking money flow, the histogram here actually went up a little bit. Well, it declined on Tuesday, and the red line's going down. So smart money indicator number 2 is still negative, and we're also declining below zero with the Chaikin oscillator. So 2 out of the 3 smart money indicators are showing more weakness. And we're going up with the red line, down with the green line with the vortex, another primary indicator that's negative. But not seeing all that much of a change here with the cumulative advanced decline line for the S&P, just chopping along sideways where we saw a little bit more of a decline based on volume. And we're driving. The reason I'm bringing this chart up this time is this is the NYSE advanced decline line in red, and we're dropping below the 200-day moving average. That's what the moving averages measure is the advanced decline line, not the S&P. So this dropping below is seen as more negative. And we came down with the cumulative advanced decline line on the NYSE. We're coming back down and slightly dropping below the moving average with the regular NYSE advanced decline line. And see, the other one too is also dropping below the moving average. And we're seeing a little bit more weakness here with the new highs minus new lows. And then this is the 50 period moving average. It's rolling over a bit, but we're still positive with this for right now. That's just showing that internally the S&P is holding up on a longer term basis. And then we look at the common stock based on price, that declined also on volume. So we're seeing a little bit more declines that are being picked up more with the charts. And we're also below zero with our 5 period moving average of the highs and lows across the broad market. That's also more negative. And then the NYSE, new highs minus new lows. The black bars here are the daily values. The red line is a 50 period moving average, and that's declining and just barely positive right now. We're below the moving average with the NYSE common stock for the advanced decline line. We declined, but we're still above the moving average with the S&P, but we're declining with the mid caps and small caps. The ratio between large caps and small caps, and it's again, as I've been pointing out, it's not that the large caps are doing that well, it's that small caps are doing terrible. And that's why we're continuing to see this ratio go up. We're further below 50 with those stocks inside the S&P 500 that are above their 20-period moving averages. Also declining with the 50-period moving average study, 100-period moving average study. And we're getting a little nervous here. We're at 50.4 now with the 200-period moving average study. If we start dropping below 50, that's going to turn things negative, and that may mean we're below the 200-day moving average for the S&P. That's the negative side. The positive side is the smart money sees what we're looking at right now, and they're like, maybe it might be a good time to come in and buy. Now, we don't know that, but we have to look at both scenarios at the same time. All right, short term, here we are, coming down close to the 200-day moving average. Now, this is the first time in quite a while we've been down here, going back to 2023. So this would be a pretty severe test. If we hold, that could really turn things back more positive. If we break it, naturally, that's going to turn things more negative. We're going down with the 20, 50, and 200 period moving averages on the S&P. We're extreme now, negative. We're getting far away from the 20 and now the 50 period moving average, and we're declining but still above zero with the distance away from the 200-day moving average. And then we have our usual short-term charts. The Stochk RSI, extreme negative, as is the Williams percent R, CCI 14, CCI 20. This is all confirming that the short-term momentum is really quite negative right now. And even the stochastics were negative in the short term, turning up a little bit in the intermediate short term, but still extreme. And now we're starting to go extreme with the long short term stochastic. And the reason why I say it that way, this is a further subdivision of the short term time frame. And we hit that lower Keltner band here with the force index. They're very similar to Bollinger Bands. Condition of the short-term trend still showing weakness. We're below the green line and the blue line and going down. We're below the 20-period simple and exponential moving averages, and the lines are going down there. We're in the -3 channel with our standard deviations chart. Now, in the intermediate term, the balance of power, we're below zero and declining. That's negative, and we're getting really, really close here to the 200-day simple moving average for the S&P. Have we come close enough? Are we going to be able to bounce up out of this, or are we going to see more tug of war going on and actually drop below it? We're negative with the go, no go with the deep purple smoke on the water bars here, and we're hitting the lowest low value on this chart. That's negative. And I just wanted to throw this in to show on a percentage basis where are we at. Now, I draw these, and so the percentages are probably not exact, but we're down, according to this, from the high that we set just a few weeks back. We've dropped 6.77%. Now that's more, I mean, concerning, but if we get closer to that 10% level, especially if that's going to happen below the 200-day moving average, that's kind of scary. So we just want to keep an eye on this because 10% or more from the all-time high, that's now classified as a correction. If we fall 20%, now we're in a bear market. Okay, and we're continuing to decline here with the TTM squeeze, and we're getting close to this extreme negative reading. We're moving pretty fast here with the standard deviation as we've been coming down. We're declining here with the ease of movement. We're below zero. That's negative. We're also negative with the Arun indicator. The oscillator is below zero and continues to decline. And then the McClellan oscillator is below zero and declining. So now we're going down based on price. We've already been declining based on volume. And we're below zero and declining with the NYSE McClellan oscillator. So we're going down with the summation index for the NYSE based on price and volume. And we're back to looking more negative now with the Swanland trading oscillator. We were flat after Monday. Not, we're still kind of flat here based on volume, but we've declined back below zero with price, and we're kind of declining here based on volume. And momentum is clearly negative now. The PMO dropped below its midpoint and is declining. We're declining based on price and volume. We're declining with the PMOs that are rising. The buy signals are now back to going down, and we're rolling over with the PMOs that are above zero that are inside of the S&P. We're negative with the Elders Impulse system for the S&P. We're negative with the parabolic SAR since the dots are on top. And we're getting extreme now with the slope oscillator. Now, there's nothing magical about this red line. I put it here. I just kind of eyeball it and say, okay, what looks like an extreme level? And I just put the line on here as kind of a guide. And then more short to even somewhat intermediate term is the MACD. That is going down. So all of our oscillators, short, intermediate, and long term, are declining. We're also going down with the Copic curve, which is another momentum oscillator. We're coming down and possibly getting into this pink area. That would be extreme negative for the Sean trend meter. We're below 50 and declining with the money flow, and we ticked up a little bit, but we're below 50 with the ultimate oscillator. And for the first time in quite a while, on balance volume is dropping below the moving average. That's turning more negative. And we're negative here with the RSI 14, but we're starting to get extreme negative with the shorter term RSI 9. And the condition of the intermediate term trend, below both lines are going down. We're below both the simple and exponential moving average based on 50 periods. We're below the 100 period moving averages as well. And we're now possibly going to test the 200-day moving average. Or have we already? Did we get close enough? We'll see. And then looking at these anchored moving averages, we're losing more support here. As I've been trying to point out, this orange line, this is kind of an intermediate term low that we set here. I would really be watching the blue one. That was more of a significant low that we set almost a year ago now. And that was a pretty significant downward move that we came up out of. So we'll be watching to see if we hit that support level. And we're still declining with the bullish percent index below 50 and going down. That's negative. We're going down with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. After Monday, we saw a little bit of hope since it ticked up. Not on Tuesday. It came down. Now we're getting close to the point with the mass index where it might be generating a signal. I only show this chart when we're up near the red dashed line and the blue line. There are three criteria for this to trigger. Criteria number one is being met right now, crossing above the red dashed line. Criteria number two is we go above the blue line. Criteria number three is if when we come back down and cross back below the red dashed line again, and whatever the market did, which in this case is going down, which is causing the mass index to go up, that suggests a reversal. Now we don't know. Some of these signals were actually ended up being pretty good. We had one right at the beginning of the year that helped a little bit, but the market's just kind of stalled out and lost its upward momentum. And we're getting close, but we're not quite there yet with the spring bottom fisher. This was a really good signal here. If you're shorter term, right? In January, this crossed over. This actually crossed a day or two before we bottomed. And then we saw the cross here, and you could have rode this little wave up if you do more short-term type positions here. And we're just barely extreme, closing a little bit outside of the lower Bollinger Band, which does not happen very often, nor does it tend to last for very long. All right, then we're below the cloud with the Ichimoku cloud here, and we have the blue line and the red line going down as well as the green line. So this is turning more negative. Now, for the first time in a long time, I'm actually showing fib retracement levels in the daily video. I usually just show this in the deep dive video, which shows the charts that I really don't talk about. Well, if we break below the 200-day moving average, we're going to be watching the 61.8% level, which is at about 56.91 right now. This is calculated from the low that was set almost a year ago to the all-time high that was set a couple of weeks ago. And we'll see if this ends up meaning something. And this is kind of longer term that I've been pointing out for quite a while. We hit the upper end of this trend channel and we that's where we started to really stall out. Okay, we're negative with the Heiken Ashi. We're negative with the Kegi chart red and pointing down. We're negative with the Renko chart. We're negative with the three-line break. All right, we had enough of a downward move to draw in a new O. We're still working on a double bottom breakdown that was registered at the end of February here. And this is not a healthy looking chart right now for the point and figure way that we analyze this. Long term, we're starting to drop below the midpoint here with the 150, and we're getting really close. We're just at 252. This line's at 250. So, I mean, the market's getting to a point where if if support's going to be held, we've been breaking lots of other levels of support. Now we're hitting some major support, the longer term definition of positive versus negative. So we're going to need to see some smart money coming in, not just at the open, but what are they going to do driving us into the close if they start buying? And we're negative in the short and intermediate term with all the stock indexes. Bonds are still positive in the short and intermediate term. Commodities are negative in the short term, and the dollars, it got hit hard, and it's back down to a negative trend in the short term. And all the sectors ended up being down, but it's a little bit encouraging if you're positive on the market. Tech was down, but down the least. And then in second place, communication. And let's see, discretionary. I got hit hard again down here. But these two growth areas being down the least, that's why I say that the mega caps outperform because this is where the mega cap stocks are at for the most part. And saw an awful lot of red as we were going down. Tried to get back to some green or blue areas as the NASDAQ was bouncing up. But you notice the time. This is like an hour, 2 hours, and then 1 hour before the market even closed. This is when we were bouncing back up and possibly looking more positive. Well, then we dropped after that. And the Dow just not looking really good right now, but still above its 200-day moving average, negative with the Elder's Impulse system. We're falling below the 200-day moving average with the NASDAQ. Now, last week, this had provided some support after Thursday going into Friday. We've now lost that support. We're still hanging on to support with the NASDAQ 100. We did drop down. We came down a little bit below this pivot point, and it's really hard to see, but we closed just slightly above the 200-day moving average for the NASDAQ 100. But we're negative with the Elder's Impulse system, and the momentum is negative. And I'm also just following a chart of the triple Qs here. This maybe is a little easier to see, where we came down below the 200-day moving average, but then we're able to close back above it. So that support level is holding for the time being. Small caps just getting hammered, down another 1.5%, breaking through support levels and continuing to go down here with the Russell 2000 small caps. And even though we're getting a really extreme negative reading with the RSI, it doesn't seem to matter right now. Maybe it will on Wednesday. We're negative with the small caps with the Elder's Impulse system, dropping further, but closing well off the low with the mid caps, even though they were down over 1.5%. and negative with the Elder's Impulse system. Financial sector just got hammered. It's been one of the more solid areas, coming all the way back down and even a little bit below its 50-day moving average, down 3.5%. And we're also watching the bank ETF, which got spanked a little bit on Tuesday. It's dropping further below its 50-day moving average. We want to watch this. There's something weird going on in the financial sector. Okay, the Wilshire also testing its 200-day moving average and so far closing above it and coming close to the 200-day moving average with our total US stock ETF. You see a lot of convergence around long-term moving averages? Yeah. We came down a little bit with our staples to tech ratio, but still this has been spiking up as the market's been becoming more defensive. And the FANG index still a ways to go to get to its 200-day moving average and did also close up off of the low. And Apple was down 0.88%, dropping below its 50-day moving average. Now you got Amazon, which just set an all-time high not too long ago. It's testing its 200-day moving average, came down but closed off of that. So we're seeing some hope here, but this hope has to lead to something. Microsoft, this is looking more negative though. Even though it was up a little bit, we're seeing a recent death cross here. The downtrend is now starting to become more apparent for Microsoft. Google is underneath its 200-day moving average, even though it climbed 2.34%. We're falling underneath the 50-day moving average with Meta. Nvidia falling further below its 200-day moving average, even though it was up. This is why I say the mega caps outperformed, even though a lot of them got hit. Some of them held up okay. And Tesla still underneath its 200-day moving average, down another 4.43%. Netflix still above its 50-day moving average, even though it declined slightly. And not really seeing much of a change here in the short term when we look at US versus world stocks. Longer term, though, we're seeing the correlation going down here. And world stocks are kind of hanging in there a little bit better right now. Well, they've been going sideways where the red line's the S&P, that's been coming down. That's why we're seeing this correlation weaken. Usually it's the other way around. Oil is dropping further under 70. That's not necessarily inflationary, but it's producing growth concerns. It's like, oh my gosh, is anybody going to ever want oil ever again? All right, and then the dollar, it got hammered. It was down almost 1% here below its 50-day moving average, but still in a longer term uptrend. And we came back up a little bit, but we're still underneath the 200-day moving average with the 10-year yield. And coming down, it's still looking more solid recently, though, with the 10-year based on price. And we're watching this. This is a ratio between stocks and bonds. And if we are up in this area, that means the market is anticipating not going into a recession. If we drop down below the rainbow and then the rainbow rolls over, that means that the market anyway, is anticipating that we will go into a recession. And we've been just coming down pretty ferociously here with this ratio overall. We're still not to the bottom end of the rainbow yet, but the fact that this is coming down, this is the concern that we're seeing in the market. And we're also coming down, but not quite to the bottom end of the rainbow with the Qs, which is the NASDAQ 100 compared to bonds. Home construction just still looks negative. It started to turn negative back in December here after looking really solid, and it's just not looking good right now compared to bonds. We're still regular here with the 10 to the 2-year yield curve, but we are inverted still with the 10 to the 3-month. And we're keeping an eye on the 10-year yield in Japan, just in case that comes into play at some point. If the market doesn't have enough to freak out about, it'll decide to freak out about this. Still seeing more weakness overall with our growth to value ratios. Q's to S&P, even though it bounced up a little bit. Discretionary still going down compared to the S&P. A little bit of a tick up when we compare large cap growth to value. So large caps, mid caps, and small caps actually bounced up a little bit here, but still below a declining moving average. And we're watching this too as the market has been becoming more defensive. The staples to S&P ratio, it ticked down a little bit here, but it's really been spiking up as the market's been getting more defensive. This is another one. I usually been only showing this in the deep dive video once a week. This is a variation of the 200 period moving average study that I showed earlier. Well, this is developed to look more like an oscillator where we get an extreme positive or negative reading, which we're not getting. but we're dangerously close to this 50 level. If we drop below it, that's going to turn things more negative. This is showing that same thing. It's a chart. I don't know if I found that on Twitter, whatever. But these are the percent of stocks above their 200-day moving average. Now it has it at 48.11. I still have it slightly above 50. And I like this weakest since November 2020. I don't do these weakest since things because look at the context. We were going up here. We've been coming down here. The context is completely different. Okay, now we do have a non-confirmed Hindenburg Omen. The Perma Bears are partying tonight. Okay, and if you don't know what a Hindenburg Omen is and you having trouble sleeping, go through and read this. You'll be out in about a minute and a half. There are three criteria, according to the chart that I'm going to show right after this, that need to be met for a Hindenburg Omen to be legitimate. And we've just seen signal number one right here. This was generated March 3rd. There's a 1 day lag with this chart. Now, this is stockcharts.com. They put all the criteria into this chart, so I don't have to do it. Where the Perma Bears, we just get close to kind of a Hindenburg Omen the first time, and they're declaring it as a done deal. At least the guy that I usually follow, or kind of watch at a distance sometimes. But now, within 20 trading days, by March 31st, I actually broke out a calendar and counted the days here. We have to see another spike, and then it will be a confirmed Hindenburg Omen. What happens when we have a confirmed Hindenburg Omen? Well, they were screaming loudly right before the COVID crash, and it was screaming loudly at the end of 2021 going into 2022 before we went into the cyclical bear market. Now, we've had a few spikes along the way here over the last year, but they have not been confirmed. So you can maybe, no, I guess you can't really make a case for that one back in the fall. Um, but we need to see another spike here between now and March 31st for this to be a legitimate signal. Okay, so what's the outlook for Wednesday? We are still negative in the short and intermediate term. We're becoming oversold again in the short term and a little bit oversold in the intermediate term, and we're dealing with the 200 period simple moving average. We're going to get the MBA Mortgage Applications Index. We get that every week. We're going to get the ADP employment change. Now starts more employment data from now for the rest of the week. And we're going to get the big one is going to be the ISM non-manufacturing. These are the services. This has been an area that's held up well above 50. Above 50 shows expansion, below 50 shows contraction. If that comes in weak, this could really hurt things in Wednesday's session and cause these economic fears to grow. If it comes in strong, it might appease the market, at least for a little while. And we're going to get factory orders as well. And then the geopolitical things, the tariffs, what's going to be the fallout? Apparently, Zelensky now wants to come back and sign a precious rare minerals deal. So after talking it over with Europe for a couple of days, he wants to talk again. We'll see if that ends up leading to anything or another boxing match inside of the Oval Office. Okay. And then on Thursday will be the weekly jobless claims. We'll get those all the time. And then the productivity and unit labor costs with the big employment report on Friday. And then here's a box around all the stuff coming out on Wednesday. And then Thursday, just jobless claims. And then Friday will be coming up as well. Seasonality, not too bad compared to a couple of days we just went through. The Dow is neutral to positive. We're flat out positive for the S&P. And neutral to positive with the NASDAQ. Now, we just use this as a guide. We don't make decisions around this. And this is what we're seeing right now. Really choppy start to March. Man, it's like you're on a roller coaster here and a very bumpy road. But we do see some positive seasonality now. But look what comes after. Now, this is these solid lines. This is regular. The dashed lines, this is a post-election year. And that tends to hold up a little bit better, maybe because more damage was done. And then next week, of course, is when we're going to get CPI, PPI, and a lot more data coming out there. We're still in the first half of March, which is the second best performing half of the month going back to 1950. And here's one. Good riddance to February. Better times could be ahead. We'll tell that to Monday and Tuesday. March, a little bit better, and then April, and then you have this buy, sell in May and go away. Well, May, June, and July end up being pretty strong, especially for tech. That's kind of one of those old cliches that the market used to use that sometimes is true, but lately has been dispelled based on what we've seen over the last few years. This is also updated, and take your pick. The black line, these are all post-election years. We're going below that. And then we have the incumbent party loses. That's what happened when Biden lost. That's the pink line, and we're actually coming back down to there. And then the green is the aggregate cycle, Stock Traders Almanac here, where it looks a little more positive than what we're seeing right now. So we got some making up to do, possibly. And then this shows February, March, April. This could be a pretty bumpy time before things tend to get better when you take this composite together. And March tends to be up 65% of the time with a positive return. Okay, now, depending on your interpretation of the charts, the accumulation distribution, it's declining, but we're still slightly above the moving average. Okay, is that positive or negative to you? And I like to keep all three of these together. And since it's declining, that's why it's on the warning sign slide here. Chaikin money flow is declining, as is the Chaikin oscillator. We're declining with the McClellan oscillators and summation indexes, both for the S&P and the NYSE. Parabolic SCR for the S&P is negative. The bullish percent index charts that we look at are all negative. We're negative with momentum for the S&P. The Swanland Trading Oscillator, it's coming down based on price. It's kind of flat right now based on volume. Ease of movement, money flow, and ultimate oscillator. These I count as secondary indicators. They're all negative. Vortex is negative. It's gold here because it's a primary indicator. And then we have the momentum for the NASDAQ 100, which is negative, and also dealing with its 200-day moving average. Longer term, we're still positive with our growth to value ratios and discretionary to staples, but man, they're getting hit in the short term. And our advanced decline lines, we're still, and this is because of the S&P. We're seeing other weakness dropping below the moving average, but the S&P is still above its moving average. And the financial sector is looking okay, but man, it got hit. And we're even further underneath the 50-period simple moving average with the bank ETF. We just want to watch that, see what's going on there. So our conclusion, we are negative in the short and intermediate term. We're hanging on to being positive in the long term. And we're back to looking more oversold in the short term. We're getting slightly oversold, but not a very long list right now in the intermediate term. Now we're still positive in the long term, even though we're dealing with the 200-day moving average. It won't officially turn negative until we see a death cross. The last signal that was generated here is a golden cross. That's when the 50-period moving average, which is shorter than the 200-day moving average, crosses above. Now, if we still have a long ways to go for that to cross back below. What we're dealing with right now is just price versus the 200-day moving average. And we'll see how that test comes through. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.